Listen carefully, because what I'm about to tell you is urgent, and it affects millions of Americans who rely on Social Security. January 1st is not just another date. It is a moment where new rules go into effect that could drastically impact your benefits, your income, and the financial security you have worked so hard to build. Many people go through life assuming Social Security is stable, predictable, and straightforward. The truth is far more complex, and if you don't take the right steps now, you could find yourself losing thousands of dollars or more over the course of the year without even realizing it. These changes are not minor. They are structural, and they are designed to shift responsibility onto individuals while quietly adjusting how benefits are calculated, taxed, and enforced. This is not fear-mongering. This is a clear-eyed look at the realities of the system and what must be done immediately to protect yourself. To begin with, the Social Security system has always been more than a retirement plan. It is a vast, intricate network of policies, rules, and regulations shaped by decades of legislation, economic pressures, and political decisions. Every January 1st brings adjustments that seem technical at first glance, slight modifications in thresholds, calculations, and reporting requirements. But these technicalities can have enormous real-world consequences. If you are already receiving benefits, whether full or partial, even a small change in income limits or taxation rules could reduce your checks unexpectedly. If you are approaching retirement, the choices you make now could impact your lifetime benefits. The system rewards preparation and penalizes delay, yet most people do not realize the urgency until it is too late. The first layer of complexity comes from the way benefits are calculated and adjusted. Cost of living adjustments are the most visible change that happens every year, and they are often framed as a raise in benefits. However, these adjustments interact with multiple other rules that are less visible but equally important. Medicare premiums, income taxation thresholds, and overpayment clawbacks all shift alongside these adjustments. The net effect can be surprisingly negative. Many people celebrate the nominal increase in their checks without realizing that the increase could be largely offset or even entirely canceled by higher deductions or stricter enforcement of income limits. Understanding the interplay between these adjustments and other structural changes is critical if you want to maintain or increase your financial stability. Another key point that is rarely explained is the increasing automation of Social Security administration. Years ago, errors could occur, but there was often room for human discretion, appeals, and negotiations. Now, the system relies heavily on data cross-referencing with IRS records, employer reporting, and automated detection systems. This means that mistakes are caught more quickly, but it also means that penalties are applied automatically with little opportunity to correct them afterward. If you fail to report income properly, or if your earnings exceed the newly established limits, even by a small amount, the system may withhold benefits immediately. That withholding may not be refunded in a timely manner, creating cash flow problems and confusion. Awareness and preparation are now more important than ever. Income limits, particularly for those under full retirement age who continue to work, are a major area of concern. The rules governing earnings before full retirement age reset on January 1st. Many people assume that small overages will be excused, but the system is precise and the penalties are immediate. Even $1 over the limit can result in benefit reductions. These reductions are often implemented in ways that are not immediately apparent. You may not notice the reduction in your check until months later, at which point it becomes more difficult to correct the situation. Planning your work schedule, consulting with financial experts, and understanding exactly what counts as income is no longer optional. It is essential. Taxation is another critical piece of the puzzle. Many Americans are unaware that Social Security benefits are subject to federal income tax depending on total household income. This includes wages, pensions, investment income, and other sources. The January 1st rule changes adjust these thresholds and can bring more people into higher taxation brackets without warning. The result is that even though you may see a slight increase in your benefits due to cost of living adjustments, a larger portion could be taxed, leaving you with little or no net gain. Understanding how these changes intersect with your personal income situation is a crucial step in maximizing the benefits you are entitled to. Medicare is tightly linked to Social Security, and changes that affect your benefits also have ripple effects on premiums. Many beneficiaries are caught off guard by increases in Medicare Part B or Part D premiums, which are automatically deducted from their Social Security checks. What looks like a modest benefit increase can disappear entirely after these deductions are applied. This is particularly important for older Americans who rely heavily on Social Security as their primary source of income. Planning ahead allows you to see the true impact of the changes before they take effect, rather than reacting after the fact. The coordination of benefits with other government programs is another often overlooked element. Supplemental programs, such as Medicaid or supplemental income assistance, may also have thresholds tied to Social Security income. A small adjustment in reported benefits can affect eligibility or the amount received from these programs. It is essential to understand not just Social Security rules in isolation, but how they interact with the broader network of assistance programs. A holistic approach can prevent unexpected reductions in total household income. Overpayment enforcement has become increasingly aggressive. In the past, there was some discretion and flexibility when overpayments occurred, but now notices are issued more quickly and collection procedures are automated. The January 1st rule changes often include expanded definitions of reportable income and stricter monitoring schedules. Failure to comply, even inadvertently, can trigger large repayment demands. This is not about catching fraudsters. It is about structural enforcement that assumes compliance errors will occur and penalizes them promptly. Proactive action is the only effective defense. Another hidden aspect is the complexity of spousal and survivor benefits. For couples, especially older couples, understanding how January 1st changes affect combined income is essential. The calculation of survivor benefits, spousal benefits, and the interaction with earned income thresholds can be labyrinthine. Misunderstanding these rules can lead to reduced household income and missed opportunities for strategic planning. Careful analysis of your household situation before the rule changes take effect is critical to protecting long-term financial stability. The psychological impact of these changes should not be underestimated. Many people experience anxiety, confusion, and stress when they suddenly realize their checks are smaller than expected. This stress can affect decision-making and lead to costly mistakes, such as withdrawing from retirement accounts prematurely or taking loans that could have been avoided with proper planning. Knowledge and preparation act not just as financial protection, but also as emotional and psychological shields in an increasingly complex system. The principle of timing is fundamental. January 1st is not an arbitrary date. It is a hard reset. The system expects compliance and adjustment immediately. Delaying action until after notices arrive can be costly. For those nearing retirement or receiving partial benefits, timing your retirement, earnings, and reporting of income can mean the difference between maximizing benefits and losing thousands of dollars. Proactive steps taken in the weeks leading up to January 1st can create opportunities that are simply unavailable afterward. One of the most overlooked truths is that the burden of understanding and compliance rests entirely on individuals. The system does not actively notify you of every nuance, and assumptions are rarely in your favor. Relying on general advice, outdated information, or secondhand tips can be dangerous. Each year brings modifications that affect eligibility, calculations, reporting, and penalties. Staying informed through official sources, consulting experts, and reviewing personal financial situations in detail is no longer optional. It is essential. Many people do not realize that partial retirement benefits interact with earned income rules in highly specific ways. These interactions can produce unexpected outcomes, including delayed benefits, reduced payouts, or retroactive clawbacks. Understanding the formulas that govern these interactions allows you to plan your work hours, retirement date, and reporting strategy in a way that protects your financial position. Ignorance, in this case, is not bliss. It is expensive. The interconnectedness of Social Security, taxation, and healthcare programs makes comprehensive planning crucial. Simple changes in income or work activity can cascade into multiple areas of financial exposure. For example, reporting an unexpected bonus or selling an investment could affect not only Social Security benefits, but also Medicare premiums and taxation of other income. Being aware of these connections allows for strategic timing of income, deductions, and withdrawals to minimize negative impacts and maximize benefits. Even for those who are fully retired, January 1st rule changes are important. Adjustments in cost of living, taxation, and reporting can affect the timing of Social Security claiming, withdrawals from retirement accounts, and overall tax strategy. Planning in advance allows you to align withdrawals, benefit claims, and income recognition with the new rules to avoid unnecessary reductions. This level of strategic planning separates those who maintain financial stability from those who experience unexpected losses. Record keeping has never been more important. With increased automation and data cross-referencing, documentation is critical. Every report, earnings statement, and income source should be accurately tracked and retained. If a dispute arises, having clear records is the most effective defense. The system assumes compliance, and if you cannot prove it, the benefit of the doubt does not go in your favor. Finally, the overarching principle is that action is power. Waiting, assuming, or ignoring changes is risky. Being proactive, understanding the system, consulting experts, and adjusting before January 1st ensures that you are in control of your benefits. The system is complex, but it is navigable if approached strategically. Knowledge is your strongest ally, and preparation is your best defense. Understanding, planning, and acting before the rule changes take effect is the difference between protecting your financial security and experiencing avoidable setbacks. The truth about Social Security is that no one will protect your benefits better than you. These changes are structural, deliberate, and far-reaching. They affect earnings limits, taxation, reporting requirements, spousal benefits, survivor benefits, Medicare premiums, supplemental program eligibility, and overpayment enforcement. The January 1st rule changes are not just technical, they are transformative. They create challenges, yes, but also opportunities for those who understand them and act strategically. Awareness, preparation, and timely action are not just advisable, they are essential. The time to act is now, before the rules take effect, before mistakes happen, and before your hard-earned benefits are reduced unnecessarily.